Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Treasury yields fall along with the dollar as fresh US data sustains expectations for the Fed to trim rates next week. Former New York Fed President William Dudley calls for a jumbo half-point cut. Christine Lagarde says the euro area's downward growth trajectory is, quote, pretty obvious. Bloomberg understands governing council members have not ruled out another rate cut next month. Plus, Boeing's largest union says no to a deal, setting the stage for a strike involving 33,000 workers. We'll bring you the latest on that developing story. Happy Friday. Yes, yields are lower. The dollar is softer. Other currencies getting a lift on the back of that. And the market set for a positive end to the week, at least as things stand. European futures pointed to gains of 0.4%. The data out of the US, the focus on the jobs claims, softer than expected. The producer prices, frankly, were mixed, but certainly did not close the door on a 25 basis point cut from the Fed. And again, Bill Dudley, of course, formerly of the New York Fed, suggesting that a jumbo cut is still something he would favour in this environment. FTSE 100 futures currently flat. S&P futures flat as well after the gains that came through yesterday. NASDAQ futures also holding at that flat line right now. We'll see how that evolves, of course. Let's flip the board and look cross-asset because the moves are more pronounced in the bond markets and in the FX space as well. Bloomberg dollar index is softer. Euro dollar in focus. We're hearing from Joachim Nagel of the Bundesbank speaking to the press in Germany, suggesting that the inflation target of the ECB will get to 2% by the end of next year, that core inflation will move lower as wage prices ease. Euro dollar 110 moves again across the Treasury curve. Bonds are bid, yields are lower, down 5 basis points. Look at that, 358 on the 2-year, 358 on the 2-year. A Wall Street Journal report as well, pointing to the discussion at the heart of the FOMC as to whether or not they go 25 or 50 next week. Gold at record levels, up 0.4% on the yellow metal, 2,568. And Brent crude, $72.43. Some upside coming through now in oil, up 0.6%. The big industrial story of the moment, though, is what's unfolding with Boeing. In the last hour, Boeing's largest union voting to go on strike after rejecting a labour deal, setting the stage for a walkout then involving 33,000 workers. The decision comes as the plane maker, of course, struggles to recover from a series of manufacturing missteps. This is a breaking news story. Let's bring in, at this point, Bloomberg aviation reporter Danny Lee for the latest. Danny, what do we know?
So we're less than 2 hours away now from a strike. We got the results from the union vote, and so 95% of the workers rejected the Boeing deal that was negotiated by its union leadership, and a further 96% backed a walkout. So clearly a comprehensive sound there that union workers are unhappy. They want a much better deal, and specifically a much better deal based on higher pay. The 25% over 4 years is not good enough, and therefore going back to the negotiating table is clearly going to be critical, and how much more that will cost Boeing and how quickly they can resolve this in order to stop any stoppage in production, costing them more, potentially billions down the line.
Danny, talk to us then about what history tells us around how long this strike could go on for, and what is the ability for Boeing to up this offer, and what does it mean in terms of the production of some of these key planes?
Well, the last strike, the last strike basically lasted over 50 days, and that cost billions to Boeing. But in this recent context, the fact that there's so much hinging on needing to get planes out the door, Boeing needs the money. So therefore, the imperative is to get this deal done quickly. And we just have to wait to hear from Boeing what they're going to say about this result, and then how quickly themselves, Boeing and the union, will get together to hash out new terms and potentially something that is more palatable to the workers.
OK, Danny Lee on this, of course, breaking news story, aviation reporter with all the details. We keep across this story for you and get an update as well in the next 30 minutes on the Boeing strike story. Let's cross over to Asia right now, to Singapore, I should say, for a check on the Asian markets and the yen again in focus for us. Avril.
Yeah, Tom, yen in focus, climbing for 4 straight sessions. It is really about next week when we get the Federal Reserve as well as the BOJ. In the meantime, in the here and now, we're seeing the region stock gauge managing gains and indeed headed for a climb for the week. The likes of the Chinese tech names that are lifting the Hang Seng, including Meituan food delivery giant, managing to get a credit upgrade, but it looks pretty mixed the rest of the region. CSI 300 erasing gains from earlier in the session. This is despite reports of those mortgage rate cuts, and then Xi Jinping practically telling government officials they're going to need to work a lot harder, do more to kind of let the economy reach the growth target of around 5% for the year. As I say, and as you mentioned, it is really about the Japanese currency, and given how it's strengthened, we're seeing that pressure really come through on the Nikkei, erasing the gains of about 3% just a day ago. Remember, this is the tech and automaking stocks that are getting hit. The Japanese companies pretty much have to recalibrate those earnings projections if the yen continues strengthening. Flip the board. Against the backdrop of those lower US yields and the softer dollar, we've also been seeing the Chinese currency climbing, but you also, even as you watch out for the PBOC signals and how it seems they've been letting it move more flexibly and tolerating the strength, wonder at the same time how much longer they will tolerate this. They don't want this unfettered strengthening in the renminbi. Now, as you see here, a lot of the other Asia currencies also benefiting from the softer dollar, including on the yen, where we're seeing it sitting around 141 against the greenback, strongest level since the start of the year. Flip the board. I also wanted to recap those BOJ watchers' expectations. The results of a Bloomberg survey are out. About 50 plus BOJ watchers were polled, and we saw the majority of them expecting a rate hike from the central bank by the end of January. More than half saw one coming in December. So it gives you a sense of what is expected from the Japanese central bank. Of course, next week, no change is expected, zero chance of that seen by most. It is too soon, especially after the July rate hike, as well as the ensuing market ructions. Tom.
OK, Ava Hong in Singapore. Yes, the Fed decision next week, but also the BOJ at the end of the week on Friday, of course. Now, the latest set of US economic data doing little to dissuade investors about the trajectory of anticipated Fed cuts. For more, let's bring in Bloomberg MLive strategist Mark Cranfield. Mark, help us understand the move into treasuries today, softer dollar. Is this a question of the data that crossed yesterday out of the US, where arguably there weren't any major surprises, or is it what we've been hearing from Bill Dudley, formerly of the New York Fed, or indeed the reporting out of the Wall Street Journal around this debate at the heart of the FOMC?
All of the above, I should think. It's feeding into a climate where traders were very keen to look for anything which would suggest that the bond rally could continue and the dollar could continue to fall in the near term, because that's pretty much where the positioning is, and anything that feeds that narrative obviously is going to help. If you look at the data itself, the jobless claims obviously was a little bit worse than expected, and that will be a reminder to people of the big issue in terms of the Fed, and that's the employment situation. That has changed. They were looking at inflation a lot more. They've swung their emphasis towards employment, and so seeing a slightly higher number there obviously feeds into the fact that maybe the Fed is already behind the curve. And then, as you mentioned, there are a couple of media reports out there as well, not really telling us anything new as such, but a reminder that the discussion most likely next week has to be about 25 or 50 basis points. It must be something that they consider. In the same way, the central bank in New Zealand discussed a larger interest rate cut, but in the end, they went with a smaller one. But it's going to be a reasonably close call because the world has moved on. Most of the G10 countries have started lowering interest rates. The ECB did so again yesterday. So the Fed may well feel that they are at the tail end of this and they need to do a little bit of catch up. There could be some internal pressure on them. That may be the reason they go over the line and get a consensus and go for the larger move. It's by no means guaranteed, but certainly there's a lot of smoke out there, whether there's really fire or not, but traders want to believe it. And you can see that move you mentioned in the 2-year Treasury yield is very unusual in the Asian market scene to see such a large move in a short end of the Treasury curve, sometimes in the 10-year, but very rarely in the 2-year.
OK, a lot of smoke, not necessarily fire, but again, the focus on the 2-year, the moves in the Asian session. What does it tell us then about market pricing? How split, how divided are traders on that question of a potential jumbo cut next week, Mark?
Traders are certainly moving that way. If you look at the very short-term pricing, they're not fully for 50 basis points, but they've gone way beyond 25 basis points. So clearly there's a number of them that think that. Probably more significantly, the fact that they're pricing for 100 basis points by the end of the year, that does mean that somewhere there has to be one 50 basis points cut, because we only have 3 meetings. The maths don't add up otherwise. So even if the Fed doesn't go by the larger amount next week, traders will continue to push, thinking that they will have to do something by the end of the year, maybe waiting until the December meeting. But clearly, if you look at the curve is actually pricing for something like 200 basis points worth of interest rate cuts into the middle of next year. That's an extraordinary situation when you think that the Federal Reserve hasn't even started and they haven't even given any indication of whether or not the pace is correct or not. Now, there are going to be a new set of Fed dot plots announced in September. At the last one, they reduced it to only 1 interest rate cut for this year. That looks completely out of line. They need to revise their outlook, especially for 2025. If they do so anything like in line with the market, the traders will really feel as though the Fed is going their way, and they will stick with those large bets for much deeper interest rate cuts. It's going to be a very interesting situation. So watch the dot plots next week.
OK, a reminder that we have the dot plots of revisions to those forecasts from the FOMC, the Fed, next week, as well as that decision, of course, as to whether or not they go 25 or 50. And we'll see how that debate evolves in the days ahead. MLive strategist with the context and these market moves. Mark Cranfield, thank you very much indeed. Now, Bloomberg has learned that the ECB governing council members believe they are not yet in a position to rule out a rate cut at their next meeting in October. This comes, of course, as policymakers weigh any downturn in the economy as underlying inflation projections nudge higher.
The risks to economic growth remain tilted to the downside. Lower demand for euro area exports, owing, for instance, to a weaker world economy, or an escalation in trade tensions between major economies, would weigh on euro area growth.
OK, joining me now is Bloomberg's Lizzie Burden, who is in Frankfurt for us and, of course, was covering all of this for us yesterday as well in terms of the ECB decision and what we heard from Christine Lagarde. Lizzie, so we had a downgrade to the growth forecasts from the ECB, but a slight nudging up in terms of their views on inflation. Where does that leave the question of October, then, for the ECB?
Well, Tom, we're still very much in the dark. Yes, as you say, they've downgraded the growth forecast for this year and the years ahead. At the headline level, they haven't upgraded the inflation outlook. And notably in the press conference, as you heard there, Christine Lagarde talking about the risks to growth tilted to the downside, but no bias mentioned when it came to inflation. We've just had some more ECB speak from the Governing Council. Joachim Nagel, in an interview, actually offering some encouraging words on how he sees inflation calming down. And he's at the hawkish end of the spectrum, mind you. Simkus as well, saying that more cuts need to happen as inflation's calming down. But before we get too dovish, look at the press conference, Tom. Christine Lagarde had all the opportunity in the world to signal that an October cut is coming or to rule it out. Just think how clearly she telegraphed that June rate cut. But yet again, she took this data-dependent, meeting-by-meeting approach, very much sitting on the fence, telling us they're not sticking to a predetermined rate path, that there isn't a particular data point to watch. And by that, she means, look, there isn't that much data between now and the October meeting. When you get that next inflation print, traders don't overreact to it if it goes down, because inflation could yet go up again before the end of the year. So where does it leave traders in that October cut? Well, they've pared their bets now from 40% at the start of the week to 20% roughly now. And this is what economists expected anyway. They were thinking that rates were going to come down by a quarter point, quarterly meetings to 2.5% this time next year. It looks like, Tom, at this point, we're going to have to wait for Christmas to deliver another rate cut from Frankfurt.
OK, Lizzie Burden, thank you very much indeed. And how we think about the next steps for this ECB. Yes, just one inflation print and some PMIs before that next decision in October. Later in the show, we're going to dive deeper on the ECB and its potential path ahead with Peter Pritt, the ECB's former chief economist. That is an interview well worth tuning in for, 6:30 a.m. UK time. Coming up, Donald Trump, Kamala Harris are back on the campaign trail, trading barbs over the debate. The latest in terms of the race for the White House. That's next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, Kamala Harris and Donald Trump traded jabs over their first presidential debate in their return to the campaign trail, with the candidates visiting two crucial swing states. Vice President Harris kicked off her blitz with a rally in North Carolina, while former President Trump pledged no taxes on overtime at an event in Arizona.
I'm also announcing that as part of our additional tax cuts, we will end all taxes on overtime. You know what that means? Think of that.
My plan is to give a $50,000 tax deduction to start up small businesses. Because, not everybody started out with $400 million on a silver platter and then filed for bankruptcy 6 times.
OK, for more, let's bring in Bloomberg's Bill Ferries. So, Bill, we heard from both candidates there on tax, whether it's small businesses or overtime. Donald Trump then seeking to regain the initiative or regain his footing, depending how you characterise it, after a debate that was widely seen as a win for Harris. Has he succeeded? Talk to us about the plans around this tax cut, how feasible that is, and whether or not that's going to inject new momentum into his campaign.
Yeah, so that's the latest economic proposal from Donald Trump. We've seen him make several in the last few weeks on the economy, which is, of course, for both candidates, the top issue to address and to show that, they're on top of what voters' concerns are. Donald Trump's proposals before this latest move on overtime were calculated to cost about $10.5 trillion over 10 years, which is more than all the federal agencies' budgets combined. So very high costs there. This would add to that. It's not clear how much of it would get through Congress, but he's certainly trying to target those working class voters who are going to be critical to this election for either candidate in all the swing states. So he's out west, and he's talking to he's having rallies, talking to voters in places like Arizona, Nevada. These are all places with a lot of, hourly wage workers who would benefit from this proposal. There's a lot of workers who fit that bill in Pennsylvania, too. So all the critical states that will decide this election in November.
OK, interesting. So we'll watch to see if that moves the needle on the polling. And that $10.5 trillion price tag. Wow, that is quite a number, isn't it? In terms of this potential debate, it's been back and forth. Are they going to debate again or not? Do we have clarity on that? Is the door closed on that question? Trump, Harris and another debate.
Yeah, so Donald Trump was out earlier just saying that there will be no third debate. Of course, the first debate was that one against Biden that prompted the president to eventually pull out of the race. He is widely seen, even by some of his key aides, as having not had the strongest performance in his latest debate against Kamala Harris. The Harris campaign has been pushing ever since that last debate ended to have another debate at some point in October. The president ruling that out. He's tried to spin it as saying he's already won 2 debates and doesn't need to have a third one. He said the Harris campaign must feel like they're on the back foot since they're proposing another debate. But I think most people who watched it feel like the vice president came out slightly stronger in that one. I don't rule out the former President Trump changing his mind on this. We've seen him do that on other issues. But for now, he is ruling that third debate out.
Okay, Bill Ferries with the latest in terms of this election campaign. The important points to hit, of course, as we continue to monitor how that story evolves. Bill, thank you for the update. Coming up, data center challenge. We're going to look at how booming demand is affecting power markets and the green transition. We're going to break that story down for you. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Happy Friday. Now, globally, data centers already use more electricity than most countries, with demand only set to grow, of course, as the AI boom continues. Already a hub for data centers, Texas could offer a window into the future for other power markets staring down this monumental challenge. Here to tell us more is Natalie Limba Dibratha, an associate in the US power team at Bloomberg NEF, who's been crunching the data for us and bringing us the context. How much of an impact, then, are data centers having on Texas? We'll start there because it's something, as we've said, of a case study.
Yeah, thanks so much for having me. So Texas has really emerged as the Bitcoin capital of the U.S. In the last few years, a wave of Bitcoin mining facilities have been built across the state. The size and energy intensiveness of these facilities means that the electric demand growth from these facilities are really growing at a much faster rate than other demand sources we've previously seen, such as population growth. In 2023, these facilities compose of about 4% of Texas average demand. In 2030, BNF's base case forecasts this to grow to 16%, which is on par with the oil and gas production that's also a rapidly growing demand source in Texas. If even more data centers come online, our bull case has this at 24% of average Texas demand in 2030.
So potentially from 4% to 24% by 2030. Texas's infrastructure, its power grids, we know they're vulnerable. So how effective has this been? Has the grid been, has Texas been at providing the energy that's needed for these data centers?
Yeah, so it's definitely not an easy task. Texas is also a clean power leader in the U.S. It has one of the largest wind fleets currently installed. On top of that, BNF expects solar capacity to triple this decade and energy storage to tenfold. However, we do see renewables not keep up with the rate of demand growth. So through 2030, our forecast shows that even more gas and coal will actually have to be burnt to meet these new demand sources.
So coal as well. So it's a mix of energy sources coming through. So renewables, coal, and oil is going to have to come through. What does it mean for prices, for power prices then?
Yeah, so overall, BNF expects power prices to climb in this decade as demand outstrips supply, reaching $80 per megawatt hour, which is about double prices seen last year. On top of just average power prices, the changing demand and supply mix will also introduce more hourly price volatility. So all of that solar is going to come online and depress midday power prices. And these data centers and oil and gas facilities are running around the clock. So evening and nighttime power prices will likely be higher than levels we've previously seen.
What about capacity? Are there incentives there then, economically, to continue to build out capacity to support this kind of demand?
So the Texas legislature has actually passed a lot of different laws to try and introduce reliability. One of them is the Texas Energy Fund, which is to build about 10 gigawatts of new natural gas plants through this decade to help with reliability as well as these new demand sources. Okay,
Natalie, fascinating stuff. A really important breakdown, the case study really that Texas provides in terms of how to support these growing demands around data centers. Natalie Limba-Dibratha, an associate in the US power team at Bloomberg NEF. And you'd like to hear more from the BNF analysts and all that detail, download the Switched On podcast on Apple, Spotify, or wherever you get your podcasts. And, of course, you can get more detail as well on the Bloomberg terminal. Coming up, we're going to be discussing the ECB's latest rate decision with Peter Praetz, a former ECB chief economist, someone with deep insights on this central bank of the Eurozone. Stay with us for that conversation. That is next. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom Mackenzie in London. These are the stories that set your agenda. Treasury yields fall along with the dollar as fresh US data sustains expectations for the Fed to trim rates next week. Former New York Fed President William Dudley calls for a jumbo half-point cut. Christine Lagarde, meanwhile, says the euro area's downward growth trajectory is, quote, pretty obvious. Bloomberg understands governing council members have not yet ruled out another rate cut next month. Plus, Boeing's largest union says no to a deal, setting the stage for a strike involving 33,000 workers. We bring you the latest on that developing story. Let's check the markets then. Risk on in terms of equity markets. You're looking to end the week in positive territory when it comes to European and US stocks. But the biggest moves coming through in the Treasury markets and the FX space as well, with softer dollar. And we'll give you the details on that in just a second. But European futures are pointing to gains of 0.5%. The cut coming through from the ECB as expected. We look ahead now to the Fed decision, of course, of next week and the BOJ on Friday. FTSE 100 futures currently pointing modestly higher by 0.1%. Most of the components within the commodity space, if you leave out iron ore, are higher today, pushing up gains. S&P E-minis currently up 0.1%. Nasdaq futures modestly higher, pointing to gains of 20 points. Let's flip the board because the moves into treasuries have been pronounced. So yields down, bonds are bid at the front end. The 2-year at 3.58. That is a move of 5 basis points lower as the debate continues, of course, as to whether or not the Fed goes 25 or indeed 50 next week. Euro dollar 110 getting a bid up 0.1%. Softer dollar at play. Gold at record levels, 2,569 per troy ounce, up 0.5% in the session. And Brent continues to grind higher after a challenging few weeks, $72 per barrel, up 0.7%. Now, clues on when the ECB will next cut interest rates were in short supply during this week's Governing Council meeting. That's as policymakers now wait for more data on how quickly the economy is deteriorating.
Well, I'm tempted to quote, Spanish, que será, será, because we have consistently said, and we repeat again, that we shall remain data dependent, and that is particularly justified in view of the uncertainty that abounds.
Well, I'm very pleased now to be joined by the European Central Bank's former chief economist, Peter Prate. Peter, thank you for your time. What do you come away with from the press conference and the decision from Christine Lagarde? Do you have clarity on what the next step is? Are the markets right to be fading out expectations of another cut in October?
I think it was a very careful press conference. I think the Governing Council is in a sort of difficult environment, where core inflation has been revised upwards and growth downwards. I know not much, but still, the domestic price pressures remain high. And so what we have seen yesterday is a very careful, reduction of the degree of monetary restrictions. So the Governing Council remains very cautious in that sort of environment.
You were hoping, you say to us in your notes, for a change in communication from the ECB with an emphasis maybe on the labour market. We didn't get that change of communication. Why would a change of communication be important, and why do you think they refrained from that?
To me, that was maybe the only surprise. It was in the communication of the ECB. I thought they would stress, risk to growth more than what they did compared to the risk of inflation. So as usually, they keep the two assessments of risk separated and don't talk about it in relative terms. I thought they would say risk to growth, seems to be higher, and are more confident on inflation. So they separated both, and on inflation, they talk about risk on both sides. I thought the communication on growth would be a bit more realistic, I would say, because what you see is that contrary to the projections, private domestic demand remained extremely weak, which is not what was in the previous projections. And so the ECB is still confident that domestic demand, the private part, is going to catch up. But that's not what we are seeing, including in the third quarter of this year. So my surprise was that it was a relatively, hawkish communication about, the economic environment. Basically, the base scenario has not changed.
Well, that's really interesting. Do you think there's a misstep then, given what you're saying about the growth trajectory of the Eurozone? When we look at the growth picture slowing, and you say slowing more, you think, than the forecasts coming through from the ECB, and then those forecasts and expectations around inflation being now nudged up, does this look like a kind of stagflationary environment to you, Peter?
Well, I would talk about maybe some stagflationary pressures, but I think we should not exaggerate. But basically, the main disappointment, I think, is private domestic demand, which is not catching up. So growth was revised downwards marginally, but basically was supported by the external environment of the euro area. And so I think here the Governing Council could have stressed more the issue about private domestic demand. On the other hand, I think, when we look at inflation figures in terms of services, it is clear that the domestic price pressures remain high. And so on that side, I can understand why the Governing Council remains cautious in its rate, cut. But I thought they would communicate a bit more about, the risk to growth.
Well, the debate, of course, is continuing, and it's live, and we're seeing that right now as to whether or not the Federal Reserve next week goes 25 basis points or 50 basis points. Should they, Peter, go with a jumbo cut, the Fed? What would that mean for the ECB as we lead up to October? To what extent would that play into thinking? Would that, for you, move the dial towards another cut in October? Should the Fed go 50?
I think it could. Governing Council members are going to deny that, but I think if there is a big cut in the US, it also shows, that, the Fed sees a sort of deterioration of the growth environment in the US, and we know also the situation in other countries like China, and so that would have an impact on markets, of course, and probably also on the currency. So I would see that a bigger cut in the US would probably have some impact on the October meeting. The October meeting will not be in Frankfurt, so usually there are not many big decisions taken, when the meetings are not in Frankfurt, but I mean, it could happen. So I think if the Fed cut by 50 basis points, I think the probability of a cut, in October would be higher. But still, I mean, the base scenario for the ECB is December. But December is far away. Many things can happen. So the ECB tried, to keep optionality, but basically in a very cautious, way. We're going to see what happens with the currency, of course, after the Fed meeting.
OK, so we look at the currency, we look at that Fed decision, of course, and the ECB and Christine Lagarde reiterating that they remain data dependent. Peter, what for you on the data set between now and October should be scrutinised?
Well, I think there's not much information, actually, between now and October. That was one of the reasons why many expect, including in the Governing Council, that nothing will happen in terms of decision in October. I think what is very important, of course, but there will not be data, is the situation of wages, because wages have a big impact on services inflation, and we know this is the biggest issue. I think the PMI, for me, what we see in the PMI, in business service for the October meeting will be key, alongside, the decision in the US. So you have basically two factors. There is maybe a third factor, which is not so much discussed for the time being, is the evolution of the energy market. We know that, the ECB revised the core inflation a little bit up, and headline inflation was not changed, basically because of energy prices being slower than what was expected. If the energy market continues as today, we may see, more positive news on headline inflation, and that may contribute, to a more easy monetary policy. But base scenario for October is no change.
Peter, before we let you go, as we look at Germany and a reminder of the challenges, the economic challenges of that country, whether it's on the energy front, and you talk about energy there, or, of course, the auto sector that is prominent, the political uncertainty as well in Germany. Is it right to characterise Germany as the sick man of Europe at this point? And do the two cuts that have come through so far from the ECB help support that economy?
I mean, it is clear that the manufacturing sector is not doing well, and we know that Germany has a oversized, manufacturing sector, depending very much on classical, automobile production, and so Germany is in a difficult situation. But if you look at other countries, I mean, like France, for example, the situation is not easy. We know that, and I think what is one of the concerns that you have in a governing council is the fiscal policy in general, because we know that the budget constraints are quite high in countries, as we have seen in the Mario Draghi's report on competitiveness, that there's huge demand, for government, spending, innovation, research and development, industrial policy, etc. And so I think the concern in the governing council about fiscal policy is real, and it has a tendency to be a bit on the hawkish side, when you have, sort of a fiscal environment, which is so difficult as we see today.
OK, Peter Pratt, really valuable insights and analysis. Former chief economist, of course, at the European Central Bank, on the importance, of course, of thinking about the fiscal stimulus that may or may not come through from some of those members of the Eurozone. And, of course, the PPI or the PMI data in focus and the consequences of what a jumbo cut from the Fed could mean for the ECB and whether or not that would open the door for an October cut, a third cut from the ECB. Remains a question, of course. Peter Pratt, thank you very much indeed. Now to other stories making the news this Friday. UK Prime Minister Keir Starmer arriving in Washington ahead of a meeting with President Biden. Sources have told Bloomberg the two countries are discussing allowing Kyiv to conduct strikes inside Russia using Western cruise missiles. Speaking yesterday, Russian President Vladimir Putin said such strikes would mean NATO countries would be at war with Moscow. Bloomberg has learned that several EU nations intend to challenge the IMF about its plan to engage with Russia on economic issues for the first time since the invasion of Ukraine. The IMF said earlier this week it's restarting annual reviews of Russia's economy because the economic situation is more settled than before, calling it, quote, a mutual obligation. Coming up, 33,000 workers set to down tools at Boeing within hours. The latest on the plane maker's new troubles next. This is Bloomberg. Welcome back now. Boeing factory workers are poised to walk off the job, crippling manufacturing across the plane maker's Seattle commercial jet hub after members of its largest union voted to strike. The decision comes as the company works to recover, of course, from a series of manufacturing missteps. Let's bring in at this point Bloomberg's Julie Johnson, who's on the ground for us, monitoring, of course, this evolving story. Julie, what is the latest? What led to this decision? The union bosses had suggested they should take the deal. They have not.
Well, Guy, you have to wonder if any deal would have passed muster with this labor force. Union leaders announced a little while ago that workers resoundingly defeated the contract proposal by management, and more than 96% voted to strike. I mean, that's a pretty strong message right there. And we can get into the sort of the payback that's been a long time coming in the eyes of many of the people who voted today that I spoke with. But it's really something else for Boeing.
Julie, what is your expectation that Boeing will up their offer? How do you think management will respond to this vote?
I don't think they have any choice but to come back with a better deal. And so I just want to, before we get into that, the union did something very unusual, or that none of us had expected. And they filed an Unfair Labor Practices Act tonight, which means that this will go into federal mediation. And now, I'm not a labor expert. I don't know the ins and outs of that process. But what I do know is that it's not something that's going to be resolved in a day or two. So this is the beginning of a longer process towards getting to a final deal. And so that's going to be really interesting. In terms of from the factory floor viewpoint, the 25% pay increase that Boeing offered was just not in the ballpark. And these are people, who you've got to feel some sympathy for people who've seen their wages stagnate and then just really got clipped by inflation this decade following COVID. And they were locked into a long-term deal that was well below, the skyrocketing cost of living. So folks have been thinking about this and seething, and they've paid a price, and now they really want payback.
Okay, they need that payback. It could cost, some analysts suggest, between $3 billion to $3.5 billion in terms of the cash flow for Boeing. Julie, given all the other challenges that this aircraft maker is facing, what does it mean for production of their key aircraft, given the time frame you're looking at?
Right. Well, everything will either slow down dramatically or shut down for commercial airplanes. In the next couple of hours. Workers have their strike signs, and they're streaming out to factory gates all over Seattle and Portland. And so it's not going to be good for Boeing Commercial. And I think this is another reason why Boeing has a really strong incentive to up the ante and get a deal done. And something else, a couple of analysts have pointed out that, okay, this is 20% of Boeing's global workforce, but from a dollars and cents perspective, they account for less than 5% of the cost structure at Boeing Commercial. So there's got to be some give there, given the importance of this group, I think, towards getting a better deal. But we'll see how it plays out.
Yeah, indeed. Julie, thank you very much indeed. Julie Johnson on the ground for us, covering, of course, all the twists and turns of this breaking news story around Boeing and the decision by members of that key union, of course, to go for a strike and the implications on that plane maker. Some breaking news headlines as well to bring to your attention then. The Danish logistics business DSV signing a deal to buy Schenker for 14.3 billion euros. That is so far the lines that we have. Undertakings with German employees of the company, it says, will be discussed as well. They are entering into undertakings with the employees in Germany of Schenker. DSV signing a deal, this is the logistics company DSV, to buy Schenker for 14.3 billion euros. That is the enterprise value. We will bring you more details on that story and a stock, of course, to watch at the open. Now, OpenAI is releasing a new AI model capable of performing some human-like reasoning tasks. Known internally as Strawberry, the company says it can handle complicated maths and coding problems. Let's bring in our tech reporter Annabelle Drulers in Hong Kong for the details. Annabelle, is this a new level of AI capability? What does it tell us about competition within the space?
Well, certainly, of course, OpenAI is helping or hoping that this will continue to give it that sort of edge in the space. But yeah, when it comes to the competition, well, it's very stiff. We know we've already got the likes of Anthropic, for instance, Google, that are saying that their advanced models still have some element of reasoning capability. But this is the sort of next level or next leg that OpenAI is talking about here. So as you said, it's known as Strawberry internally. Externally, it's known as O1. And so the company says that the model can perform reasoning tasks. Now, just to give a little bit of context on what that means, as you said, it's sort of that human-like intelligence. So essentially, it allows it to consider lots of different types of knowledge or inputs, use reasoning, and then come to an accurate answer. So in practice, how that will actually function, well, the company is saying, be prepared for it to take a beat. So you'll put in a question, it might take a little bit longer to respond, and that's because it has that background process that it's going through. It's really a step forward for the company because we know they've been trying to get its model to carry out multi-step actions for some time. Now they're saying it's here, but of course it's not being rolled out to all users of ChatGPT, just some of them, and the company is saying it's going to use those experiences to continue to develop and advance the tool.
OK, Annabelle Drulis in Hong Kong on the update coming through from OpenAI, and we'll see how well received that is, of course, by users as some get their hands on that new model and that new capability, of course, this week. Plenty more coming up. We're going to give you some insights in terms of what's driving gold to these record levels. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Happy Friday. Let's just reflect on the producer prices that came in yesterday. Of course, we had CPI and now producer prices crossing yesterday in the US. Jobless claims as well, worth focusing on because the jobless claims actually picked up somewhat. But on producer prices, top line is relatively benign. It's a bit of a mixed picture, quite frankly. But in terms of the important details, the components that go into that PCE gauge that is so important and focused on by the Federal Reserve, those were relatively benign. Think about airfares. They actually dropped 0.8%. Now, on a month-on-month basis, headline, producer prices ticked up 0.2%. Year on year, though, in line, 1.7% in line with the surveys. And again, if you strip out the components that go into PCE, it's looking a little bit more benign. It was a bit of a mixed picture, but bottom line is it doesn't really change the equation in terms of producer prices, it seems, as to whether or not they go 25 or 50. Maybe the jobless claims is more important in that. Maybe what we're hearing in terms of the reporting around the debate that's happening within the FOMC around that question is more important in terms of how you think about pricing, and certainly seeing your action in the Treasury markets today. You have the University of Michigan survey later today as well. The sentiment around the consumer, of course, important. You're thinking about the labour market. We know the balance of risks for the Federal Reserve has now switched focus to the labour market, and of course consumer sentiment ties into that, and it is expected to soften again. So just think and reflect on that Michigan University survey coming out with a consumer sentiment survey later today. Let's flip the board and have a look at what's happening in gold, because at record levels, and part of that is down to what is coming now in terms of this synchronized level of cutting from some of the major central banks. The central banks are at play in terms of buying as well. So lower rate environment, obviously softer dollar, supportive for gold, but also the buying of central banks has been there, still is there. Retail investors also getting some skin in the game. And arguably as well, some of the bearish positions, some of the shorts on gold, you're seeing some evidence that some of those have been unwound as well. So gold at these record highs. Coming up on the opening trade, Richard Hughes, the chair of the UK Office for Budget Responsibility, is going to discuss the country's challenged, quite frankly, fiscal outlook. That is at 7:30 a.m. UK time. That will be a really interesting conversation. The opening trade is up next. Stay with us. This is Bloomberg.